The shock didn't come quietly. It hit markets fast, and it hit consumers even faster. As tensions escalate into open conflict involving Iran, the global economy is once again staring down a familiar but dangerous pattern: war-driven inflation. Prices begin to move before headlines fully settle. Energy markets react within minutes. Supply chains tighten almost overnight. And for everyday people, the impact shows up where it always does first: fuel, food, and basic goods. The immediate trigger is obvious. Iran sits at the center of one of the world's most critical energy corridors. Any disruption in that region sends oil traders into a frenzy. Even the threat of supply constraints is enough to push prices higher. Tankers hesitate. Insurance costs spike. Shipping routes become uncertain. And in a market already sensitive to geopolitical risk, that uncertainty translates directly into rising costs. Oil is not just another commodity. It is the backbone of modern economies. When oil prices surge, the effects cascade through nearly every sector. Transportation costs rise, which means goods become more expensive to move. Manufacturing becomes more expensive, especially in industries reliant on petrochemicals. Airlines raise ticket prices. Logistics companies pass costs on to retailers. And retailers, in turn, pass those costs on to consumers. This is how inflation spreads. It does not stay contained within energy markets. It leaks into everything. At the same time, financial markets begin to reflect growing anxiety. Investors pull back from risk. Stocks become volatile. Safe haven assets attract attention. Government bonds, gold, and defensive sectors see increased demand. But even these shifts do not provide stability. They simply signal that confidence is weakening. Currency markets also react. Countries heavily dependent on imported energy face pressure on their currencies. As energy bills rise, trade balances worsen. This weakens the value of their money, making imports even more expensive. That creates a feedback loop. Inflation rises further, and central banks are forced into difficult decisions. Raise interest rates too aggressively, and economic growth slows. Hold back, and inflation risks spiraling out of control. Consumers feel the pressure almost immediately. Fuel prices climb at the pump. Grocery bills begin creeping higher. Imported goods cost more. Household budgets tighten. And when people feel uncertainty, they change behavior. Spending slows in some areas and spikes in others. Essentials take priority. Discretionary purchases are delayed. Panic buying can emerge, especially if supply disruptions become visible. Shelves empty faster. Prices adjust even quicker. This behavioral shift is critical. Inflation is not just a mathematical outcome. It is also psychological. When people expect prices to rise, they act in ways that make those expectations a reality. Businesses raise prices preemptively. Workers demand higher wages. Contracts adjust. The cycle feeds itself. Meanwhile, governments face growing pressure to respond. Strategic reserves may be released to stabilize oil supply. Subsidies might be introduced to shield consumers from rising costs. But these measures come with trade-offs. They can provide short-term relief, but they also strain public finances. And if the conflict drags on, the long-term consequences become more severe. Energy infrastructure could be damaged. Shipping routes could remain unstable for extended periods. Sanctions could tighten further, restricting global supply even more. Each of these factors would reinforce inflationary pressures. There is also a broader geopolitical dimension. Countries begin reassessing their dependencies. Energy security becomes a priority again. Alliances shift. Trade relationships evolve. In the long run, this could reshape global supply chains. But in the short term, it adds another layer of disruption. Markets hate uncertainty. And right now, uncertainty is everywhere. Corporate earnings forecasts become harder to predict. Businesses struggle to plan. Investment decisions are delayed. Hiring slows in some sectors. Layoffs may follow if conditions worsen. This is how inflation, combined with geopolitical instability, begins to weigh on economic growth. The risk is not just inflation. It is stagflation, a scenario where prices rise while growth stagnates. This is one of the most difficult environments for policymakers to manage. Traditional tools lose effectiveness. Raising rates to fight inflation can deepen economic slowdown. Stimulating growth can fuel even more inflation. For consumers, this environment feels relentless. Every trip to the store costs more. Every bill becomes harder to manage. Confidence drops. And when consumer confidence declines, it affects the entire economy. Businesses respond to that shift. Some cut costs. Others raise prices further to protect margins. Smaller companies, with less flexibility, may struggle the most. They cannot absorb rising costs as easily. They cannot negotiate better supply deals, and they often rely heavily on consistent consumer spending. At the same time, global trade flows begin to adjust. Countries look for alternative suppliers. Shipping routes are rerouted. Contracts are renegotiated. These adjustments take time, and during that time, inefficiencies drive costs higher. Technology and automation can help offset some of these pressures, but they are not immediate solutions. Building resilience into supply chains requires investment, time, and coordination, none of which happen overnight. There is also a financial stability angle to consider. Rapid inflation can erode purchasing power quickly. If wages do not keep up, real income declines. This can increase debt burdens for households already under strain. Defaults can rise. Financial institutions begin to monitor risk more closely. If markets perceive that central banks are losing control of inflation, volatility can intensify even further. Confidence in monetary policy is crucial. Once that confidence weakens, restoring it becomes significantly more difficult. Another layer comes from emerging markets. Many of these economies are particularly vulnerable to energy price shocks. They often rely heavily on imports and have less room to maneuver financially. Currency depreciation, rising debt costs, and inflation can combine into a serious economic challenge. In extreme cases, this can lead to broader instability. Capital outflows accelerate. Governments face fiscal stress, and social tensions can increase as living costs rise. Back in developed economies, the narrative may feel different, but the pressure is still real. Even if the systems are more resilient, consumers are not immune. Inflation reshapes behavior everywhere. Retailers begin adjusting inventory strategies. Energy-intensive industries reassess operations. Transportation networks adapt pricing models. Every part of the economy reacts in some way, and all of this traces back to a single trigger: disruption in a critical geopolitical region. What makes this situation particularly complex is the speed at which information spreads. Markets react in real time. News cycles amplify uncertainty. Social media accelerates panic. Expectations shift faster than ever before. This speed can exaggerate movements. Prices overshoot. Corrections become sharper. Volatility becomes the norm rather than the exception. For investors, this environment demands caution. Risk management becomes more important than aggressive growth strategies. Diversification becomes essential, and understanding macroeconomic signals becomes critical. But for everyday consumers, the focus is simpler: managing rising costs, adjusting spending, navigating uncertainty. That is where the real impact is felt. War-driven inflation is not abstract. It is not confined to charts and market data. It shows up in daily life. It changes how people live, spend, and plan for the future. And while markets will eventually stabilize, the path to that stability is rarely smooth. The key question now is duration. Short-term disruptions can be managed. Markets can absorb shocks. Supply chains can adapt, but prolonged conflict changes the equation entirely. The longer instability persists, the deeper the economic impact becomes. Energy markets remain the focal point. As long as supply risks dominate the narrative, inflation pressures will remain elevated, even if actual disruptions are limited. The perception of risk is enough to sustain higher prices. At the same time, policymakers must walk a narrow path. They need to contain inflation without triggering a severe economic slowdown. They need to support consumers without creating long-term fiscal imbalances. There are no easy solutions. Every decision carries trade-offs. Every move is closely watched by markets, and every signal influences expectations. This is why the situation feels so tense. It is not just about current conditions. It is about what comes next. Will the conflict escalate further? Or will it stabilize? Will energy markets find balance? Or will supply risks intensify? Will inflation remain elevated or begin to ease? These questions do not have immediate answers. And until they do, volatility will likely remain. For now, the pattern is clear. Geopolitical conflict leads to energy disruption. Energy disruption drives inflation. Inflation reshapes economic behavior, and that behavior feeds back into the system. It is a cycle that has played out before, but each time the context is different. This time, the global economy is already dealing with lingering inflation pressures, shifting supply chains, and evolving monetary policies. That makes the current shock more complex and potentially more impactful. As the situation develops, one thing is certain: markets will continue reacting, and consumers will continue adapting. The story is still unfolding. If you want to stay ahead of what's happening in global markets and understand how these events impact your daily life, make sure to subscribe and stay tuned for the next update.